hoping that every single one of you buys $1 worth of Bitcoin. Just $1 freaking dollar.
This is Da Vinci. He bought Bitcoin at $1. Not many people do that.
I mean, my biggest winner to date is still a public company, actually. I was working on Tesla in 2012, and we went on to buy that for various strategies. And so far, that one's done all right.
These aren't some kind of flukes. These are examples of asymmetric investments. And the good news, you don't need some kind of crystal ball to benefit from these opportunities. You just need to use the correct strategies. And in today's video, I'm going to be explaining what asymmetric investments are, the 5 best asymmetric investment types, and I'll share practical tips to actually implement this strategy and supercharge your finances. Let's get into it. We've all heard that slow and steady wins the race, but what if there was a way to accelerate your growth? And I'm not talking about cutting corners. Imagine leveraging a single investment strategy that increases your results while maintaining your risk manageable. Welcome to the world of asymmetric investments. In nature, symmetry is considered beautiful. A perfectly blooming flower, a symmetrical face. But for investments, asymmetry is where the magic happens. You want your upside potential to be far greater than the downside risk of losing that investment. And that is exactly what asymmetrical investments offer. So let's talk portfolio allocation. So most wealthy investors, they stick to the 90-10 rule. 90% of their investments are in safe, boring assets like S&P 500 index funds or real estate, and then 10% is in high risk, high reward opportunities. And the reason for this is that 10% can actually outperform the rest of the portfolio. And if that goes bust, they still have that safe 90% of their portfolio to give them a stable foundation. So let's compare 2 portfolios from 2016 to now. So the first portfolio is a safe, boring S&P 500 index fund, VOO. It's the Vanguard S&P 500 Index ETF. And then the second portfolio is a 90-10 split between VOO and GBTC, which is a Bitcoin ETF. And if you compare these 2 portfolios, that VOO portfolio is compounding around 14% per year. That's very, very good returns. But the second portfolio is actually compounding at 31% per year. And you would think, well, you're assuming way more risk with this second portfolio. But if you look at the Sharpe and Sortino ratios of this second portfolio, it actually is a better risk to reward ratio than if you just bought into the S&P 500 index fund. And your market correlation is lower. So you have maximized the reward for the risk you're taking, and you've locked in returns that are double what the market's making without assuming that much more risk. It's like being the house at a casino. You have tilted the odds in your favor. Take Erik Finman. He got $1,000 from his grandmother, and he was able to invest it in Bitcoin in the early stages, and he turned it into over $4 million. So crypto is the first asymmetric investment. And for every crypto millionaire story out there, there's a crypto scam out there as well. Take Hawk Tour Girl.
You gotta give him that hawk tour and spit on that thing, you get me?
She launched her own crypto coin, and within minutes of the crypto coin launching, it lost the majority of its value. So you do have to be careful when you're doing cryptocurrency investing. But if you're vetting cryptocurrency projects, the best place to start is actually on CoinMarketCap. You can see how the coin has been trading. You can assess what the overall sentiment is for that particular cryptocurrency. You can see what the project is actually trying to accomplish in the real world. And you will still have to do some due diligence on the actual founders of the cryptocurrency and what their track record has been. But this is an excellent place to start if you're trying to look for that next crypto outlier project. Next, let's look at Barbara Corcoran. So she took a $1,000 loan and she grew it into a multi-million-dollar real estate empire. And she eventually found her way onto Shark Tank as one of the sharks. So she started in the 70s, but modern investors can still get these asymmetric returns by using the BRRRR strategy. So you buy, you rehab, you rent, you refinance, and then you repeat. This allows you to roll capital from one project to the next project to the next project. So you can acquire multiple properties and quickly grow a real estate portfolio. In these days, with the higher interest rates, it's unusual to get all of your money back out of a BRRRR deal, but you still get the majority of your capital out. So it will reduce the amount of time that it's going to take to save for that next investment. So the key to making this strategy work well is to acquire properties at the right price and to account for all the potential costs. So this is all the maintenance, any potential vacancies, any property manager that you might put in place. Your underwriting of that property has to be sound so you don't stack up a bunch of properties and then the house of cards collapses on you. So let's talk about the Oracle of Omaha, Warren Buffett. He is famous for asymmetric investments. He would buy undervalued companies at a good price and then he would hold them for the long term. And they don't call him the Oracle of Omaha for no reason. He is one of the best individual stock pickers of all time. Luckily, you do not have to be the best stock picker of all time to get about the same results. One strategy that I like to use is investing in leveraged index funds. So over time, the S&P 500 has been returning about 10% per year. But you can buy a 2x leverage version of the S&P 500 and turn that 10% into 20%. And just like last year, in 2024, the market went up 26%, you can double that to over 50% returns. So TQQQ is a 3x leverage ETF of the NASDAQ 100. The NASDAQ 100 went up 30% last year, and TQQQ went up 79%. So not quite 3 times, but it's way more than 30%. So you may think that these returns are not sustainable, but if you look at these graphs for these returns on these ETFs for the long term, I'll let you draw your own conclusions. There will be some volatility with these because they are leveraged. So if you are skittish or you're going to freak out the first moment that these things start going down, they are not a good investment for you. But that's also why they should be limited to 10% of your portfolio. And if you don't know the first thing about stock investing, I actually did an entire investing for beginners video, and you guys can check that out. So the next person I want to talk about is Naval Ravikant. So he took small investments in Twitter and Uber, and he was able to turn that into millions of dollars. And his net worth is right around $100 million now, and he's on track to become a billionaire. So this type of investing is called venture capital investing, where you are investing in startups that have a high potential of growth, but they also have a high potential for failure. And I'm not going to sugarcoat this. VC investing is very, very challenging. Over 90% of startups fail, and it requires a lot of capital to actually invest. And generally, if you're investing in a startup, you are rich already. You have to be an accredited investor, and there's ways to get it with certain licensing, but the requirement most people are familiar with is having a net worth over $1 million, or your income, if you're single, being over $200,000 for the last 2 years, or over $300,000 $5,000 the last 2 years if you're married. So if you pick companies that are backed by some of the largest venture companies like Andreessen Horowitz's venture company or Sequoia Capital, it improves your odds from only 10% to about 25%. So only 75% of the companies they invest in fail, and overall about 90% fail. So it's a tough business to break into, and you have to make a lot of bets across a bunch of different companies before one hits. But if one of those companies hit, it is millions and millions of dollars. So picking the right company to invest in is like finding a needle in a haystack. But if you are interested in this startup investing, you can do it on a couple platforms. So EquityZen, a Hive, or AngelList are examples of platforms that me and my wife have used to invest in startups. So let's talk about Marques Brownlee. So you may know him as MKBHD. He reviews tech products, and he started at the age of 16 reviewing these products on a simple webcam. But at the age of 31, he scaled that content creation to a $28 million empire. And content creation is the ultimate asymmetric investment. You literally put $0 in, but there are so many different avenues to actually monetize it. There's the affiliate links where people can buy products. There's the ad revenue that you get from platforms. There's the opportunities to funnel people to an underlying business that you might have. There could be merchandise. You can have subscription services to masterminds or coaching. You can have courses. You can have e-products. You can have physical products.
Broil it, bake it, saute it. There's shrimp kebabs, shrimp creole, shrimp gumbo, pan fried.
The sky is the limit on how you monetize and grow a content creation business. And you don't need a ton of employees. You can be a single person making millions of dollars. It will require a ton of patience. It will require that you invest heavily in a large set of skills, and you constantly are improving the content and the value that you're creating for people. But if you're willing to invest that time and energy, you will start making money. And here's a bonus example. Jeff Bezos. Jeff Bezos was able to take a $10,000 initial investment into Amazon and scale it into $1 trillion business. And for a while there, he was the richest man in the world. And businesses are the ultimate asymmetric investment. They start very small, but there is no limit to how big they can scale. So there are a ton of YouTube channels dedicated to how you should start and grow a business. And I'm not going to get into all that today. But I would like to say, if you're trying to pick a business, some of the key things you should look for is a business with a high margin. So that means that the total expenses are low and the potential revenue that you can generate is high. So you have a large profit margin in that business. And then you want to pick a business that has a large total addressable market. You don't want a small niche business. It's possible to be successful, but you would have to charge much higher dollar amounts if the total addressable market of your business is very small. And generally, the easiest businesses to start are service-based. So it's you providing a service to someone else, and you aren't selling a physical product. So disclaimer, none of this is financial advice. Everyone's risk profile is different, and you need to vet all these investments for yourself. And asymmetric investing is not about gambling. It's about taking calculated risk. And if it's done correctly, it can change your life. So start small, stay consistent, build that solid foundation, and then with a small portion of your capital, take that shot at the moon. Keep getting 1% better every day, and I will catch you guys next time. Will this keep you entertained? Are you entertained now? You entertained? Entertained?